Hey everyone, and welcome back. Today, I want to talk to you about systematic trading, precisely where and how to start. Now, this may sound like a trivial question, but I can assure you that newbies especially have some doubts before they start trading with this kind of approach. So in this video, we're going to try and shed some light on this. Before we start though, as always, please be sure to subscribe to our channel, click on the notification bell, and please leave us a like to this video as well. Thank you so much. Hi, we are the Unger Academy, and we teach traders how to make money in the markets. Our founder, Andrea Unger, had been struggling with trading for years until he developed his automated trading method, which he used to become the only 4-time world trading champion. Subscribe to our channel for free tips and tricks. Okay, guys, one of the coaches at Unger Academy here, and let's get started with our video, shall we? Well, I remember my first steps in systematic trading, and I remember that I had a lot of doubts. In particular, I remember that I wanted to take a day off from work when I activated my trading systems for the very first time. So I think that this video might be helpful to many of you. So let's jump in and see some questions that many novice traders ask. Often the first question people ask is about the platform. It's not about which platform to use, but whether you should trade through a simulated or a real platform. Now, obviously, this is for starters. So let's go and examine the advantages and disadvantages of simulated and real platforms. If we start from a simulated platform, of course, we have the possibility of trading with fake money. So basically, there's no risk of loss, which means that we can certainly approach this first step with greater serenity. On the other hand, however, there is some inaccuracy in the execution of orders. In fact, simulated platforms can't know whether an order that you send to the market would have actually been executed by the market or not. So what really this means is that these simulations are obviously different from actual market behavior. Moreover, as far as slippage is concerned, the values we get are totally unrealistic. The fact is that often these platforms are flawed in the way they work, and generally they aren't updated as frequently as real platforms. So there can be some technical problems that you wouldn't encounter in real life. Most importantly, the simulated trading experience is very different from the live experience, especially from an emotional perspective. By not risking capital, the whole psychological aspect is missing from your trading activity. So fear, greed, uncertainty, well, you don't feel them at all, as you would in real trading. So this is certainly a very different experience. And that's why I think that choosing a real platform is the optimal choice to starting systematic trading, because in this way, you'll get as realistic a picture as possible. So there is only one problem: how to minimize the economic risk. Because at the time we start, the ideal thing to do would be to be able to start trading live without risking much. So the ideal would be to be able to approach systematic trading in the most realistic way, but risking only a very small part of our capital. And how can this be achieved? Oh, that's quite simple. Just choose the right markets. So let's go and have a look at the most important features that a market should have to be considered as particularly attractive to start systematic trading. First things first, they have to have good liquidity. Now, this is let's say, more or less a general requirement. So it isn't advisable to start trading in an illiquid market. We would add one difficulty after another. Another extremely important feature is having low entry barriers, in the sense that they should be tradable also with low capital. But how can this be achieved? Well, there are two main ways. The first is financial leverage, and the second is high granularity of the market itself. As you probably know, financial leverage, which please always keep in mind that is a double-edged sword, lets you trade instruments with less capital than required to invest the contracted amount. High granularity, on the other hand, helps us because it lets us use trade instruments that actually have low cost, such as stock. A stock typically costs between $5 and $500. So, we're talking about capital that is affordable for everyone. Now, what are these markets? Let's have a look at them together. We've identified a few, the most important ones. And as I said, there are stocks. Then we have CFDs, namely contracts for difference, which we'll learn more about later. Basically, you can trade these derivatives directly through your broker. However, there are atypical derivative contracts, and each contract can be different from the others. Micro futures, these are the new futures that have just come up in the US markets. We're only talking, a couple of years ago? And that allows you to replicate the operation of a larger contract, say the mini S&P, but with 1/10 of the notional capital. So these futures were actually able to lower the barriers to entry, allowing many traders to start trading in futures also with a low capital. Then we got Forex. Now this has got very high liquidity and high granularity. And we'll see then what the disadvantages of Forex are as well. Cryptocurrency market, which is very similar to the Forex in one way. It's the new twin of Forex, if you will, because we've moved from traditional currencies to cryptocurrencies and electronic currencies. So let's go and have a closer look at the features of these different markets, particularly in terms of liquidity and financial leverage. So we're going to start with stocks. Here, by looking at this chart, we can see that stocks can be considered a liquid instrument. Now, of course, yes, we realize that's broadly speaking. I mean, if we decided to trade in small caps, sure, we'd obviously have a liquidity that might be slightly lower. So it's certainly better to stay within the largest indexes like the Nasdaq 100 or the S&P 500. Undoubtedly, these underlying assets are very liquid, but on the other hand, they typically offer pretty low financial leverage. So let's say overnight trades. You typically have a 2 times leverage. Okay. Some brokers may offer higher leverage intraday, maybe up to 4 times. So these are usually low leverage instruments, but as I said, they have a low cost, which means that you can also trade with low capital. Then there are CFDs, contracts for difference, which have gotten a bad reputation over the years. Now, this isn't related to the actual instrument itself, but rather to how many brokers have used these instruments over the years. And as I mentioned earlier, these are atypical instruments, so they can vary from broker to broker. They usually have a good financial leverage, so you can move much more capital. Remember, however, that this is a double-edged sword. But on the liquidity scale, I'd rate them at a much lower value than stocks. Again, this is broadly speaking, so it's not universal. There are brokers like Interactive Brokers, for example, that offer good liquidity for these instruments. The downside, however, is that some brokers who are sneaky during periods of high volatility tend to widen their spreads. So be extra careful when you want to trade contracts for difference, and pay attention to the broker that you use. Moving on to the following instrument, we have micro futures, which we can place between these two asset classes. These instruments have good liquidity. I mean, some micro futures are even highly liquid, like the micro and the S&P 500. Others, on the other hand, are a little bit less liquid, like the one on gold. So if we average the liquidity of these instruments, we can say that they still have good liquidity and provide good leverage. As a downside, we can certainly mention the commission aspect. In fact, the impact of the commissions when trading micro futures is higher than the impact of commissions when trading the bigger contracts. Finally, we have Forex. And based on this chart, Forex seems to be the ideal market to start with. But why? Well, because it has very high liquidity. It's one of the most liquid markets in the world. However, I'd like to remind you that it isn't a market with official quotes. So the broker you use plays a major role in this case. And this means that choosing a good broker is absolutely essential. Because as with CFDs, there may be less reliable smaller brokers who don't present you with truthful prices or who apply excessive spreads. At the same time, in addition to having an excellent liquidity, Forex also offers high financial leverage, so trading with little capital is possible. It also has very high granularity, so it would be the ideal market from that perspective as well. I say would be because in my personal trading experience, developing profitable trading systems for Forex, it isn't that easy. But maybe that's just a limit of mine. Probably. However, I recommend not starting with Forex, but starting with the cryptocurrency market because, well, that's also got many similarities with Forex. It also has very high liquidity, maybe slightly lower than Forex, but still pretty high. Also consider that the leading cryptocurrency exchanges like Binance are very liquid and offer very high financial leverage at the same time. However, unlike Forex, the cryptocurrency market offers some really exciting opportunities, mainly in terms of the ease of developing trading systems. If on Forex, as I said from my experience, it's relatively difficult to develop profitable trading systems, the same cannot be said for the cryptocurrency market. Indeed, the opposite is usually true. Namely, trading strategies that we wouldn't find working in any other market often show a more attractive performance in the cryptocurrency market. So my advice, it's definitely to go and get deeper into this market. And if I had to choose two markets to advise you to start systematic trading, I'd certainly choose the cryptocurrency market or the micro futures. These two markets, in my opinion, are optimal for starting systematic trading with very low capital investment. And if you happen to need help with this entrepreneurial activity, because, well, trading is an entrepreneurial activity, I'll leave a link in the description of this video. I'm sure you're going to find it really very useful. You'll find a free presentation by Andrea Unger, in which he introduces you to his trading method, which let him win the World Cup Trading Championships in real money trading, not once, not twice, not even 3, but 4 times. You can also get our best-selling book, The Unger Method, by covering only the shipping costs. Or, if you want, you can also book a free strategy consultation with one of our tutors. And guys, that's all for today. We thank you so much for watching. If you did like this video, please leave us a like, and also please be sure to subscribe to our channel and go and click on that notification bell. And that's it. We'll see you soon. Bye-bye.